Do retail traders fail because we don't have the same tools and resources that the big institutions have? It's a pretty interesting question, but here's one that's even more interesting. What if I told you in some ways, being a retail trader actually gives you an advantage over institutions? Yeah, I know that probably sounds crazy, but we're consistently told that big banks and institutions have better technology, more information, maybe a little bit more money, and a more sophisticated trading system, and that we're essentially playing a game that we can't possibly win. But is that true? In today's episode of the Trading Coach Podcast, we're going to break down retail trading versus institutional trading, look at the major differences in how each approaches the markets, how they execute trades, and the unique advantages and disadvantages that come with both. And at the end, I'll let you decide for yourself. If you had the choice, which side of the trade would you actually be on? So the other day, I put up a poll on my YouTube community page asking, why do most traders fail? Was it lack of knowledge about the markets? Was it the lack of a trading strategy? Or was it self-sabotage? And the results were pretty interesting. 14% of you guys said lack of knowledge. 16% said lack of a trading strategy, and a whopping 70%, 70, said self-sabotage. And honestly, I think those results tell us something pretty important about what actually matters when it comes to becoming a consistently profitable trader. And as always with the poll, I encourage you guys to hit the comment section so that we can continue to have the conversation and maybe get some ideas for awesome podcast episodes like this. And one particular comment caught my attention because I completely disagree with it. And the comment said, most traders fail because we don't have the tools that institutions have, and we're not a big enough player to swing the markets. For us, it's basically a gamble with the facade of feeling like a professional. And I wanted to address this because I think this is a belief that holds a lot of traders back. And full disclosure, I've never worked for a major financial institution, so I don't have firsthand experience sitting inside an institutional trading desk. However, I have been fortunate enough throughout my career to meet and speak with plenty of traders who have. And while many of them obviously can't spill all of the beans about exactly how they operate, they made one thing pretty clear. Retail trading and institutional trading are two very different games. They have different objectives, they have different constraints, they have different execution problems, they use different tools. And despite this popular trend on social media telling retail traders they need to learn how to trade like smart money, the reality is we don't. And I actually think that's a good thing. So let's start off with how retail and institutional traders differ from a philosophical perspective. As a retail trader, our objective is typically pretty simple. We identify an opportunity, we place a trade, we manage the risk, and hopefully we make money from that trade. Boom, that's it. The goal is to place a trade and make money off said trade. But a bank or a large institution can have an entirely different reason for entering the market. They may need to hedge exposure from another investment. They may need to rebalance a portfolio that they're managing for clients. They may need to facilitate a larger client transaction. They may need to manage their currency exposure, or they may simply be positioning themselves for something they expect to happen further down the road. So they're not always thinking, where is price going right now? They're often thinking several steps ahead. And a transaction that they're making today may have very little to do with what they expect the market to do immediately. Think about the NBA for you guys who are fans of that sport. Go Sixers, we got LeBron. Let's say an NBA team wants to trade for a superstar. They can't necessarily just call up the other team's GM on Monday and say, hey, we want your best player. Here are some draft picks. Boom. Instead, they might need to do things like creating salary cap space. They might need to do things like acquiring additional assets. They may need to move other players that are currently on their roster. Essentially, they need to position themselves financially months before that superstar trade ever happens. And most fans watching the games, they wouldn't even notice those things unless you're a basketball nerd like myself. But behind the scenes, all these little weird moves that they're making is the team positioning themselves for that bigger transaction down the road. And institutional trading can work in a similar way. And then we go into one of the biggest differences between retail and institutional traders, and that is going to be execution. And believe it or not, this is the one area where I actually believe that being a small, tiny retail trader can be an advantage. I want you to think about the overall liquidity of the financial markets as being like an ocean, the Pacific Ocean. If I, as a tiny retail trader, enter a $100,000 position on the euro dollar, my trade is basically like dropping a little pebble off the side of a boat into the Pacific Ocean. No one cares, no one notices. The market isn't going to move because of my tiny pebble being dropped in. And the benefits of that is this: I can get into the trade with ease. I can get out of the trade with ease. I can change my mind if I wanted to, and no one really notices. But imagine you're an institution trying to execute a position worth several $billion. Now you have a problem because you can't necessarily just hit that buy button and expect to get billions of dollars filled at the price that you want it to be filled at. If you aggressively buy that much in the market at one time, you're going to consume all of the available liquidity. And as you continue buying, you may have to pay increasingly higher prices to find those additional sellers. So instead of entering the entire position at your desired price, like a small, tiny retail trader would, you would actually end up pushing the market higher while simultaneously making your own entry more expensive. And nobody wants that, especially when you're talking about billions of dollars worth of transactions. So because of that, institutions have to approach execution very differently. They may test the market, they may break large orders up into smaller pieces, they may execute across different venues, they may use algorithms designed to minimize market exposure and transaction costs. Essentially, what they're trying to do is they're trying to complete a massive transaction without saying to the market, hey guys, we're about to buy billions of dollars right here, because that wouldn't be good for them. And here's where things get interesting. Sometimes an institution that ultimately wants to buy may actually need to sell first. Why, you may ask? Well, because again, the objective isn't simply to predict where price is going, it's to find enough liquidity to execute that larger transaction efficiently. And that brings us back to our original comment. We don't have the tools that institutions have, and we're not big enough players to swing the market. And yeah, that's technically true. We don't have many of the same tools, and we certainly aren't swinging a big enough stick to move the markets on our own. But here's the question. Do we actually want to be? Because I would argue that we don't need the same tools that institutions have. Those tools exist in large part because institutions have problems that retail traders simply don't have. They need to minimize their market impact. They need to minimize their transaction costs. They need to manage those enormous position sizes. They need to execute without revealing too much information to the market. And as retail traders, we just don't have those problems. If I want to buy 100K worth of euro dollar, I don't need some incredibly sophisticated execution algorithm to hide my intentions from the market. I'm too small for anyone to care. And the second part of the comment is even more interesting. We're not big enough to swing markets. Again, this is not a disadvantage. This is an advantage, because if you can move the markets with your own trade, you'd also have to deal with the consequences of moving that market against yourself when you trade. If I can personally move the euro dollar every time I place the trade, I'd probably have a much harder time getting filled at the price that I wanted to. So I see our small size as being an advantage because it gives us flexibility. We can wait, we can pass, we can enter, we can exit, we can change our mind. We don't have to deploy a lot of money to test the waters. We don't have to explain our execution to a portfolio manager. We don't have to spend weeks positioning ourselves for a transaction. We can simply look at the market today and say, I don't like this setup, I'm not going to trade. Or I do like that setup, it meets my rules, I am going to trade. And that's a pretty powerful position to be in. So I think we need to stop looking at trading as being retail traders versus institutions, because that's not really the game. The institutions have advantages, but they also have constraints. The retail trader has disadvantages, but we also have advantages as well. And ultimately, neither one of those things determines whether you're going to be a successful trader or not. Remember that YouTube poll? 14% said lack of knowledge, 16% said lack of strategy, and 70 said self-sabotage. And that tells me something. Maybe the bigger problem isn't that we're missing some secret institutional tool. Maybe it isn't that we're not big enough to move the markets on our own. Maybe it isn't that we're trading with a facade of feeling like a professional. Maybe the real battle is much simpler. Maybe the real battle is versus yourself, your ability to follow your plan, your ability to manage your risk, your ability to wait, your ability to take a loss without trying to make it back immediately, your ability to stop forcing trades, your ability to execute the same process over and over again, even when the outcome of the last trade makes you feel like you want to do something completely different. Because the market doesn't care whether you're a retail trader, a hedge fund, or a bank, or someone trading in their bedroom, right? Price is going to move. Your job isn't to become the biggest player in the market. Your job is to become good enough at managing your own behavior that you can consistently take advantage of those opportunities that the market gives you. And maybe that's the part of institutional trading that we should actually be studying. Not how to become bigger, not how to manipulate liquidity, not how to trade like smart money, but how to think about risk, execution, discipline, and process. Because at the end of the day, the biggest opponent standing between you and your trading success probably isn't the bank sitting on the other side of your trade. It's the person staring back in the mirror. Hope you enjoyed the podcast. If you did, hit that like button, follow as well. As always, I appreciate a rating and a review. And if you have any questions or comments about that, I would love to continue the conversation. Just leave it wherever you can find me. And until next time, plan your trade, trade your plan. Take care.